Good news.
Yeah.
Great news for everyone. The mortgage 0.25% rate cut, or as I like to call it, a 25 basis point reduction in the cash rate. I feel like the horse is bolting. House prices off the back of this will surge. We'll see in the days leading after this, for example, this decision. I want to get renovations done. I want to buy the next property. This was in the space of like 10 minutes after the RBA decision. I was like, The election's done. This decision's done. More rate cuts to come. Confidence is now to skyrocket. Cost of living pressures easing. I won't say with ease. It's easing. If you have a mortgage, $500K loan, we're saying that your repayments are going down, by about $100 a month?
Yeah, about $100.
So $100 a month, so $1,200 a year. On $1 million mortgage, it's $200 per month.
Well, $100 is your property manager expense. Between now, this rate cut, last rate cut, you're getting back nearly $60K.
Nearly $100K extra in borrowing capacity.
What's that?
With your future rate cuts.
Oh, yeah, exactly right. Watch the market go bang.
Okay, everyone, welcome back to another episode of the Australian Property Investment Podcast. For us finance nerds, it's a big day today. RBA meeting. We're pumped. We wait for 2:30 to hit refresh, and awesome surprise today. I always say it's a surprise, but awesome news for us.
Good news.
Good news.
Yeah.
Great news for everyone. The mortgage 0.25% rate cut, or as I like to call it, a 25 basis point reduction in the cash rate, which we know. We had a really good feeling that was coming down the pipeline today with the RBA. There's a lot of commentary that it was not a matter of if, it was a matter of how much.
Yep.
I think NAB had tipped at 0.5%, which was we thought it was a little bit ambitious or optimistic. So yeah.
It would have been welcomed.
We'd love it. But we're going to unpack a little bit today what the rate cut means for everyone. Look, we haven't gone through the minutes just yet. We're kind of coming straight hot off the press on this one. So what we will do is unpack some of the minutes that do come out from the RBA over the next couple of days and just put some notes up on our blog, I reckon. But we just want to go through what this means. If you're tuning in, if you've got a mortgage, if you're trying to get into the market, if you're an investor, for example, just what these rate cuts will mean. And I say cuts because we've had 2 already this year. This has been the second. Damien, you and I were talking, 1, 2, 3, 4, 5 more RBA meetings this year.
5 meetings.
With no meeting in June. So the next meeting is going to be in July. And some banks, economists have tipped, 4, 5 rate cuts?
Yeah, 4 to 5 in total. I think we'll have 2 to 3 potentially, hopefully.
So we had 2 and maybe 1 more, you reckon?
No, I think 2 to 3 more.
So 3 out of the 5 RBA meetings, you're saying we'll see rate cuts?
Yes.
Go on the record. All right.
Yeah, go for it. Yeah, because we're at 3.85.
Yeah.
So 3 more 0.25 would bring us down to 3.1.
Yeah.
I do think they're going to try and get the cash rate back to 3-ish.
Crazy.
3.1, 3.35 on the record.
I like it. I was thinking maybe 1 more.
Oh, really?
1 more. Yeah. Look, to me, I feel like the horse is bolting as opposed to bolt. House prices off the back of this will surge. Demand we'll see it. And we'll see it days leading up to this. We'll see in the days leading after this, for example, this decision. We're confident. I just got emails straight away before we got in.
Same. Two texts, 2 emails.
Yeah, literally.
Yeah, I had 10 minutes.
Saw emails go, hey, we'll have a quick chat. We want to do something now. I want to get renovations done. I want to buy the next property. This was in the space of like 10 minutes after the RBA decision. I was like, wait, the election's done. This decision's done. More rate cuts to come. Confidence is now starting to skyrocket. Cost of living pressures easing. I won't say with ease. It's easing. And I think everyone's adjusting. Obviously, you see where trimmed inflation is as well. So if I come back to you and what does this mean for you? Let's go through this. So if you have a mortgage, okay, $500K loan, we're saying that your repayments are going down, by about $100 a month?
Yeah, about $100.
So $100 a month, so $1,200 a year. On $1 million mortgage, it's $200 per month. And so you add that up, the savings that we've just had, 200 plus another 200, that's 400. That's nearly $100 a week that's coming back into a household. Happy days.
Party time.
Right?
Yeah.
Yeah. How much partying you're doing for $100 a week. But it just, to me, it feeds into confidence.
Correct.
And sentiment. This is a sentiment-driven market. When everyone talks about is it a good time or the right time to be buying, and this is a sentiment-driven market, and we are smack bang in the middle of a sentiment shift. And let me explain to you why. One of the key lead indicators that I personally look at is lender timeframes on applications. And now across the board, some of the lenders that we use, 10, 12, even 15 business days to pick up a brand new application. So that is inflows from brokers into specific lenders, and they are inundated with new loan approvals.
Yep.
and applications. And so to me, that's our litmus test, right? People look at auction clearance rates. That's a lag factor. That's a done and dusted on a weekend, right? When I come back to a lead indicator, what are the banks seeing as new applications? And when we see 10, 12, 15 business days, particularly on some really good quality banks that usually managed about 3 to 4 business days and it tripled that, you're going, geez, mate, they're under-resourced and they're over on their lead, so the applications that are coming in.
And these lenders are, investor focused with their policies. That's why we work with them a lot.
Lenders, yeah, correct.
Yeah, non-bank lenders.
Yeah, so you can start to see. So the market is really swinging back in the favor of the investor. When you think about it, if your repayments are going down by $100 a month, it just means that your cash flow is starting to improve. And any investor that we speak to, Nate and I in our pod and Damien in your team, the first thing they're doing is that when they're 90, 95, 100% finance, they're like, this thing's bleeding cash. And if this just starts to kind of just cut that back by, $200 a month, $300, the yields start to look a little bit better, don't they?
Well, $100 is your property manager's expense.
Right, there you
pretty
go.
much.
Yeah.
So bang, that's covered. Yeah. Yeah, yields are going to look very good. Yeah, cash flow breakdowns, I never used to do them. Now we do fairly high level, but people want to know, hey, how much am I actually up for here when rates are at this level? So
I think that's the first thing, that it's not the rates. No. It's not the rates that people, investors are looking at anymore. It's the cash flow. They're going, we do the equity strip from one property and then we do the 80-20 loan structure plus stamp duty and costs. And they're going, hey, mate, this thing's financed at 100, 105%.
Yields are 4.5%. The rates are 6.5%.
Correct.
How much do I have to put in?
So if you're listening and we're trying to connect the dots, so when we're doing, say, a loan at 500 and we're financing that, and the repayments are close to $800 a week, you're not getting $800 a week on a 500K property.
No.
So usually it might be $600 a week, and so you've got a gap of 200. And the first thing they're going is, hang on, I might have one. But the second I've got two, that's $400 a week. How on earth do investors scale? And this is probably one of the big things if you're tuning in. How do investors scale? Look, you've heard me talk. One, it's a matter of grip strength. Rates are coming down. So it's an ability to hold on, and we've held on with 13 rate rises. So I can tell you right now, it is a game of grip strength and who wants it bad enough. That's probably one part. The next part here is you could do a PAYG, tax withholding variation. Hey, look, if you want to put that cash flow back in your pocket week on week, speak to your accountant about doing a ATO withholding variation. That's another one. The other one is cash in offset accounts will really help minimize your interest repayments, for example. So instead of using cash to go and buy properties, park it in your offset account, and that may help from a cash flow and a monthly repayment perspective as well. Yeah. I'm not sure what else you guys have seen, but they're probably there's no silver bullet, but they're probably my top 3 suggestions. Yeah,
definitely. Scale slowly at times as well. Like if you are sort of feeling that pressure of the cash flow, with each property, as you grow your portfolio and as your yields improve based on the initial purchase price, it does get easier to hold properties. Yeah. So you can also scale slowly. You don't have to do 10 in 2 years, 10 in 10 years. You still get 10 properties, just a little bit slower. It could be something some people need to hear at times to say, just take it easy.
It frustrates me when we do 10 in 10 years.
Yes. But at times,
you take it slow down to speed up.
Correct. Yeah, definitely.
And it could be one of those things. And it could be a phase in where people's lives, people that are young kids, that kids are in daycare, man, I can tell you right now, it's equivalent to private school fees. And we actually have people with kids in private schools. And it's like, hey, there's a real handbrake around cash flow. And then we started to look through, okay, so is it an income issue or is it a cash flow issue? And I think we've got to really start to, if you're listening and you go, right, what does that mean? Hey, do we have a lifestyle issue here in terms of what's coming in and what's going out, income and expenses? Or is it actual, hey, can I buy a property that yields better income, a better yield, for example, as well? We will always advocate for buying through buyer's agents because you give them the brief to find a property that's yielding at X%. And that's their mandate to effectively look for something that's going to tick a few boxes for you, whether it's buying at a certain price point, whether it's buying a certain yield, whether it's a combination of growth and cash flow, for example. Yep. You really can give that brief to someone to go out there and locate, negotiate, and then find something that ticks most of your boxes as well. Yeah. Cool. So let's go in. So if we talk through today, what that means for your payments, cool. There's plenty of online calculators. We'll probably even include a couple of links to calculators where you can work out what today's rate cut means for your monthly repayments. That's one. As we said, as an investor, The cash flow starts to get better, which means your yields are looking a little bit better as well. Happy days. Borrowing capacity is what we speak about here. So I've got the human calculator on the laptop, Nate.
With his calculator.
Probably know these numbers off the top of your head. So if we said, look, someone's on a single applicant, $150,000, what is that? What does a reduction in 0.25% on the cash rate or rates in general mean for someone's borrowing capacity? So where they were before versus where they are kind of now.
I've lost it.
That's all right. While you do that, I'll just talk about where the lenders have kind of landed at the moment. So most of the banks have announced 30th of May, that discount so the 0.25% reduction in rates will take effect.
So a full discount passed on, which is really good.
Yeah. That's awesome news, right?
Yep.
So 30th of May is when we start to see that rate cut become effective. One bank we've got is an outlier at the 11th of June. got to get themselves organised, take a bit of a hit.
Yeah. Or trying to squeeze every bit of profit out.
So that's probably the big one. Yeah, and we'll keep, as we get more lenders that give their official announcements, we'll kind of look at the info that gets dropped there as well.
We're still within like an hour of the announcement, right? An hour 20. So there's going to be many more. About $30K for a single applicant on $150K.
Yep.
25 to $30K back in your borrowing capacity.
Perfect.
So you get an extra $30K in borrowing capacity. Yeah.
So between now, this rate cut, last rate cut, you're getting back nearly $60K, right?
Yeah.
Wow.
That helps.
Yeah.
That helps. And if you're right, there's nearly $100K extra in borrowing capacity.
What's that?
With your future rate cuts.
Oh, yeah, exactly right. Watch the market go bang.
Yeah. It's freaky, isn't it, when you think about what that could mean for the market this year. Cool. And then what if you're a couple on, say, I don't know, $100K each?
Yeah.
So double income, no kids.
That is about, it's all right. It's still about the same.
It's about 30K. Okay, cool. So across the board, start to see rate, the drop in rates increases your borrowing capacity. And that's what we generally say to a lot of, this is letting you into our world. And this happens for a lot of clients where now their borrowing capacity's gone up. And we're saying, right, everyone's now at ceteris paribus, it's all things equal for every other borrower out there. So automatically people just have a little more juice in the tank just to squeeze when they're starting to make offers. So just, know what that does to your serviceability.
And in a very hot market, you're also now going to get people going, okay, let's say I'm right and we have 3 more cuts. Let's just put that into the budget now. Let's bank it in and put it into our offer now, saying that, hey, they're going to cut 2 or 3 more times. We predict. Let's make an offer above what our current budget will allow, knowing that we might be down. And some people will be that aggressive. Yeah. And in those really hot markets, there's a few hot spots that are, I don't know, my client's having a very hard time buying. People will be doing that mental math. They go, I want to get in. Let's push it up. Push it up.
Yeah, cool. I think one big thing that's quite common for our conversations, particularly with clients with HECS, is what the 20%, the proposed 20% reduction in HECS. I don't know what you guys have seen. I haven't seen any talk about it just yet in terms of when it's going to get rolled out or what that looks like.
Nate, do you know? 1 June, was it?
Oh, so the 20, sorry. I don't know when it'll be effective, but it's based on your balance on June 1, 2025. Okay. Yep. So the government will calculate 20% of that.
Yeah.
So if you paid out, 20th of May, paid out today, you don't get it.
Yeah.
So if you do plan on paying it out, I guess wait 20 days. Because I'm getting a lot of clients coming back saying, hey, I'm interested in paying it out after June 1.
Yeah, same.
So get the 20% cut and then see what it does to your borrowing.
Perfect. I think we should do something around June 1 as well.
Now, if I don't pay it out but I get the 20% cut, how does that impact my borrowing?
It doesn't, unless we look at, as we mentioned last podcast, CBA. They've got their policy now, their HECS time to repay calculator, as they call it, or HELP, as it's called now, not HECS, where they'll assess how quick you're due to pay your HECS off and either ignore it completely or reduce your buffer.
Cool. Yeah, cool. Thanks very much.
But it's just to answer Danny's question. Every other bank it won't affect because they look at essentially your repayments per month.
and not the balance.
Not the balance.
Yeah, great. Thanks very much. So June 1 is the date for that. So stay tuned. If you've got HECS balance, reach out to us. Let's work out what the implications are on that 20% haircut on your HECS. And I think that's, again, we want to talk policies. That's a good policy that we're seeing. One of the policies that consistently comes up for me is lender's mortgage insurance and LMI waivers. So LMI is lender's mortgage insurance. So some of the ones I've been doing recently, bank employees. So what that means is you work for a bank, a major lender. You have two options. You can go to your employee staff or employee banking discount and go to 90%. Or you can come to us and we can do it as well. But we go through one specific lender to get that done. But yeah, it just means if you don't want to do your banking, I'm surprised that they don't do their banking with their employer.
Yeah.
They want to keep things separate. That's cool. Reach out to us and we can do bank employees. The other ones that we're seeing is registered nurses and police, frontline, ambulance, police, firefighters as well. That's got to be on owner occupied is what we're being told.
Correct. Yep.
Not the nurses one.
No, nurses RN. There's one bank that will do it on like a standard Medico policy, or LMI waiver policy.
90K
income cap.
Yeah.
So that can be,
which I think a lot of the nurses, I'd say you add in your overtime.
Registered nurses get paid.
Yeah.
Well, they work very long hours.
They do work extremely hard.
But yes.
Yeah, absolutely. I want to talk about a scenario that we did recently. So a client came to us, was told by multiple brokers, maxed out, that's it. Now, in her scenario, granted, no, like the other brokers weren't wrong, but there was a car lease that was sitting there, and the car lease was about $950 a month. Now, I get it. It's pre-tax. There are some tax savings. But I said to her, you're trying to get tax savings for a depreciating liability.
Mm-hmm.
Okay? So yes, you are getting tax savings on a depreciating liability. You also could get tax benefits off the back of an income-producing asset, which is an investment property. So just really challenge her thinking around that. So that was one.
And you're getting tax savings, but you are paying interest on that lease as well, right?
On the car.
Absolutely. Yeah. So
there's a balloon at the end of it, so you factor in the balloon payment. Look, again, I've been pretty open about what car leases do to your borrowing capacity. Murders it.
Murder.
Yeah, I think I got to give a shout out. There's a few clients that reach out when we have our initial discovery calls, like, and I'm already going to cancel the car lease. I'm like, thank you. Yeah, that it's sinking in. We're trying to shout this message from the rooftops. But what's the game that you're trying to play? You're trying to, pre-tax and load into super if you're trying to do something pre-tax.
Mm-hmm.
My gut feel, right? If you really want to make some pre-tax contributions. But the car lease to me is just it's highness what it does to borrowing capacity. And I think we even were talking about the electric car.
Which is catching so many people out. It's like a full pre-tax deduction.
Yep.
The electric car. Everyone's like, great. Because normally no value lease will be split over a pre-tax and a post-tax component.
Yeah.
It's full pre-tax. So people are like, great, save on so much tax, get a new car, perfect. But yeah, I think it's like the cheapest one I've seen is like $1,500 pre-tax per month. Right. So kills borrowing.
And the banks don't generally they won't take into account whether it's pre-tax or post-tax. They'll look at it as a post-tax.
Then it's a liability. It's just a liability. Yeah. The finance portion.
While you might be smart in a tax sense, the bank doesn't care. But they're not factoring out pre-tax. They're factoring out net.
They're looking at your base salary or whatever it is, your gross taxable salary, and then just whacking on the lease as a liability.
Yeah. So it's not actually helping. That's why we say from a serviceability perspective, it's not actually moving the needle. In fact, it's swing the pendulum away from you than to you. Okay. So car lease. So if I go back to this scenario, she had a car lease at $950 a month. Our proposal is you could pay the car lease out. She's got some savings, for example. But what we're going to do is refinance you into a 40-year loan term and do an equity strip on that. Okay. So there's one lender that will do a 40-year loan term. And off the back of that, we've gone from having no borrowing capacity to now being pulling out over $110,000, $115,000, I think, from memory. And so that $115,000 now becomes a deposit to go and buy another investment property, which is now income producing and going to compound, as opposed to the car vehicle that is not compound. It's taking away from ability to go and buy a property. And very much just by looking, and Lauren and my team, I really kind of challenged her. I said, no, don't take no for an answer. Find options, find outcomes. And to me, I just want to kind of talk about why a loan strategy and working with a strategic mortgage broker, where this can kind of really shift and accelerate your portfolio. So there's so many clients that will come to us told no by a broker, for example, that they're not doing enough valuations. They're not thinking outside the box. Like, hey, we can pay the car lease out, for example, not closing credit cards. And so it's a little bit order taking versus, hey, look, we want to be in a position where we're, top end giving strategic advice and almost telling people what to do. And I think the advice part is where probably a lot of brokers sit back and they don't want to give the advice. You're not coming to us just to kind of go for recommendations, for outcome. We are trying to shoot for outcome right now. I want to do the loan strategies. And I think sometimes, and this sounds so ridiculous, as I said, sometimes we're guilty of over delivering. Like sometimes people come back and go, whoa, I did not expect that.
Sometimes I film my little Loom video. I'm like, this is just to show you the max. You do not need to take this on.
We're going and buying 8. We're showing the capacity to go and buy 8 properties, and they're freaking out.
Yeah, they're like, I don't want that much debt. I don't want to pay that much in monthly repayments. So yeah, show you the limit.
It's a double-edged sword when we're doing our loan strategies. Like, be careful what you wish for, because that's our goal, is to deliver it and smash it out of the park, right? So for us, if we're trying to show you what you're capable of, it's because we can see a bigger, brighter, better future for yourself than maybe what you can, because of our skills and our knowledge and our insight. Again, I'm not saying we're chest beating here. It's just saying, hey, look, this is what we're bringing to the table. If you've got the ambition and the attitude, we'll meet that energy halfway and go, right, I see where you're at. Under our watch, though, and we've spoken about this, like, hey, what are our investors doing? I've had a quick look, even just my client portfolio. I'd say we've got a number. I won't be able to put a percentage on it because I don't want to butcher this stat. We've got a number of property clients that have the ability to go past 10 properties, past 10. And a lot of the clients are on the journey. They might be at 4 or 5 at the moment, but they're kind of nudging that 1% territory. And there's a reason why it's 1% territory. There's cash flow issues. It's accounting, so there's trust to be set up. So there's cost involved in that. There's cost involved with getting legal and financial advice when you're going to buy through trust or settlements or SMSS, for example. There's time to set that up. There's costs around buyer's agent, for example. But when they've put themselves in a top 1% of any category, any industry, for example, now you're a top 1% property investor, I've got to say, mate, you are in rare air. There's rare company there for you. And why stop there? And that's it. That's kind of the energy I say to people, is like, oh, I'm done. Why stop there? Imagine what your future could be, or your kids' future could be, if you just gave that a little nudge, for example, responsibly and diligently. Hey, mate, that could be game-changing stuff come your retirement. So, really just want to open the door up to that, to say, don't be afraid. I know, and if you look back in your own journey where you were 10 years ago to now, what a decade does, and we've spoken again about this, the power of a decade, and where you'll be in 10 years, would you be happy to lose $100 now to have that property compound, or even maybe double in the next 10 years? That's maybe that little light bulb moment that you may need to go, yeah, I'm getting inside my head a little bit. I'm worried about the pennies when we should be worried about the dollars on the other side. Yeah. Do you have that conversation with clients then, where they're a little bit, I won't say deer in headlights, but they're going, well, that's a lot for me to take in when you've given them your loan strategy?
Oh, yeah, all the time. Yeah, and with unfamiliar lenders that we have, like non-bank lenders, for example.
So they've never heard their names.
Yeah, so it's like, who's this lender? I don't know who it is.
Let's put their names out there. I mean, they've never heard of a Red Z. I'm like, well, hang on, they sponsored the Melbourne Storm, don't they? Yeah.
St Kilda too. Who's Pepper?
They did the Tasmanian T20 team.
That's right. Yeah.
Hobart Hurricanes.
Yeah, that's right. Yeah. Well, that's what I say to them. I'm like, just go and check out some sports teams. Yeah. You'll start to see these brands.
The Broncos.
First Mac are here.
The Tigers. Pepper at the Tigers this year.
Pepper.
There we go.
Another sports team as well, Pepper.
Pepper do St Kilda. Yeah. Or they have in the past.
Yep.
Yeah. So that's where, So
that's what they're trying to get their brand out there by going, hey, look, we're known for sponsoring a team, and that's where they're trying to lift their brand profile. This is me, my marketing hat on.
Yeah, correct.
But that's where, like, you look at a Bluestone, for example, you look at a Pepper,
Latrobe. Yeah. So they hear these names and go, okay, I don't know who this lender is. I can't believe I can borrow that much. And look at that monthly repayment. You go, how are we going to get this done? And then that really takes away from what the goal is here, and that is to buy a property. So what we're worried about is brand and repayments, and not thinking about, hey, this asset, what's it going to give back to you? Rental income. capital growth.
Whereas if we overlay the fact that you're buying a car and you know what the repayments are on that car, but the car's not going to be worth what you paid for it in about 3 years' time.
As you drive out of the dealership, it goes down.
It's like
10K or whatever it is.
You've got to really challenge your thinking on this to go, mate, the lemmings out there are driving novated leases, and then the secret millionaires are the ones stacking properties in their portfolio.
Your Toyota Yaris's.
Yeah, mate. With the Mazda 3.
Yeah.
With the Subaru. Mate. And this is...
The Subaru is quite nice.
But this is what we're talking about, going, hey, mate, you know, we're not saying have all the delayed gratification, a little bit of that. Park the bells and whistles, build a portfolio, pull the equity, go and buy the car, for example. Like that can be a good game plan.
Yeah.
But as long as you can build the asset base, you can have the toys. We're not saying don't have the toys, mate, go nuts, but just get the order and the sequence right.
Correct.
If you want to build long-term true wealth. And it's very hard. I had a chat with some of my mates the other day around the ego. Like, it's very hard to not let the ego step in. Like, can you imagine once you get to 6+ properties and you're a 1% property investor, there'd be a little bit of ego around that.
Mm-hmm. You want people to know.
Should lend me. I've got to tell them, like, property's easy, and there's an ego play at that. Go and buy the nice car. There's an ego around that, and say, how do we park the ego? We've spoken a lot around this, you know, the psychology of money, for example, The Secret Millionaire. There's some really good books that just help you go, okay, I can see that the job isn't done.
Mm-hmm.
Yeah, it's almost like a business going, revenue is vanity, profit is sanity, for example. Yeah. So it's very much the same type of mindset around a household. It's like, don't worry about what's coming in, worry about what's left over. And that is the litmus test for how well you're doing. Cool. Mm-hmm. So I just want to go back into a lot of the investors that we're speaking to. I call it that perfect little triangle. One of the 3 problems that we're trying to solve for a lot of investors. One is borrowing capacity. So looking through your borrowing capacity, the car lease, for example, is a very good example of how we try to unlock one of the challenges, which is borrowing capacity. The other challenge is equity. So have there been enough valuations done on the property? Has the property not performed an increase so there's not enough equity to pull out to strip to then go and buy future properties? Are you cross-securitized? And that becomes another issue around equity releases too. So is it borrowing capacity? Is it equity? And the third one is cash flow. So to your point, when they see the repayments, they're going, geez, I'm hemorrhaging cash flow. It's more going, hey, look, what can we do around this? Can we add a granny flat at some point in the future? Tax withholding variation, park money in the offset account, for example, that you can funnel in there. To
interest-only repayments, for example.
Yeah.
Fixing a rate if you need to at times.
Yeah. It works for some people. So that's the kind of trio. So when we're looking at kind of solving investors' problems, they're one of the 3. It's rare that I see someone have all 3 issues. Usually it's like 2 out of 3.
All 3 issues means you're not buying.
I think if you're maximizing 2, you can't have one other one, right? Like,
correct.
You run out if you're maximizing equity and borrowing capacity, there shouldn't be cash flow left over. Like, you should be pushing it because the bank's not going to lend you anymore.
Correct. Yeah, that's fair.
Yeah. So we're generally looking at that, and that's the lens that we're solving problems for investors when we're trying to break through what I call the grass ceiling. So where property investors get stuck, right? They hit a grass ceiling, they can't get through it, and it's like, hey, how do we punch a hole through that we can keep buying and scale? It's pretty much one of the exact conversations I had just before this, which was 5 properties trying to get to my 6th, and it's like there's the order and the sequence of lenders that they had them in was completely wrong. That stuff matters. And so for me, when I'm talking to clients and, people that are listening and they reach out for a, discovery call or roadmap, then the order and the sequence starts to matter. For example, we're not selling loans on rates. We're selling loans on the fit for purpose and the outcome that we're trying to get, for example, too.
Definitely. Sorry, what's that grass ceiling?
The grass, instead of a glass ceiling.
Grass because it's property. Yeah, right. Nice one.
Thanks.
Copyright trademark.
You're right, man. The grass ceiling is actually females trying to make it in sport, apparently.
Oh, right.
So I don't want to take away from that. I don't want.
Was coming to something else.
I don't want to take away from that. I'm just saying that was something I was speaking to a client the other day. I'm like, there's a grass ceiling that I feel for some people, whether that's self-imposed or whether that's financial. Hey, look, how do we crack through that as well?
Yep.
So, I mean, if you can imagine what they call those Venn diagrams where you put those 2 circles side by side and like you got a loan strategy, match with a property strategy, somewhere in the middle is a real sweet spot. That's why I say to people, engage a buyer's agent because they're going to do the property strategy for you. They're going to get the spreadsheet, which is all the expenses, all the outgoings, the rental income, show you your cash flow as well. So that's why I like to see that plan on a page from a buyer's agent. And then we come to you with a plan on a page from a borrowing capacity and the ability to buy multiple properties, whether that's through trust, personal name, for example. And when you bring those two together, you should have a very well articulated strategy, which is property strategy meets loan strategy. Okay, great. Now we've got clarity on what we're looking to do. And the ultimate outcome that I'm looking for investors is what are we doing and why are we doing it? And if you can answer those two questions, mate, you go hammer and tong and kind of buy that next property, come back, buy the next one. And then we talk about, Nate and I were spoken specifically, and even you, Damien, releasing equity in drip feeds. And so we get tactical around, okay, we're not going to do a massive equity strip. We're going to go tactically around that and go, okay, we'll buy the next 2 or 3, come back, equity strips, go again as well. So based on what you're looking to do, we've got a strategy that we kind of pull out, roll the red carpet and go, here's how we think we can execute and implement. And so if you're very keen to unpack a loan strategy, is what we generally want to say to people is, hey, if you're listening, I've been listening for a while, and now you actually want to take some action and pull the trigger, reach out to us. We're here. We'd love to chat and connect with people. And when people reach out to us, we can absolutely blast and kick out of people that have been spending the time and the hours immersing themselves and educating themselves and trying to better themselves as well. And all we're trying to do is say, as you've heard me say before, the property market rewards action takers and decision makers. Now's the opportunity, particularly this time of year when rates are starting to come down. We're going to get through halfway through 2025. You had ambitions to do something this year. Maybe it's the right time to reach out and grab the bull by the horns. Guys, thanks very much for jumping in.
Thank you.
As always, I appreciate it. It's a big day. So love to get people's thoughts on this podcast. Again, I always say, if you've loved it, you need to share it with a partner, with a friend. Make sure you're including them on the journey that you're going on as well, because more the merrier. That's a wrap for another episode of the Australian Property Investment Podcast. We'll talk soon.